Hello everybody and welcome to MD's Options Trading. Welcome to this special series on option Greeks. In earlier sessions we have seen what is delta, what is gamma, what is theta, what is implied volatility, what is India VIX and what is vega. In this session we are going to see the last option Greek. Its name is rho. Write it down like this. RHO, rho. So rho is nothing but it tells you how the option premium they will change based upon the bank interest rate or FD rate. So it's purely logical part. You can think about it and you can decide how your option premium they will change based upon the bank interest rate. So rather me telling or someone else telling, even if you put some logic behind this, you can guess how your option premium they will change based upon the interest rate. Say for example, currently bank interest rate is 6.5% per year. Tomorrow, let's assume that bank interest rate they change to 10%. Of course, they will not change immediately, but assume that currently the interest rate is 6.5, and if tomorrow they change to 10%, what will happen? So first of all, the people, those who do option selling in the market, they are the big players. Generally they are the big investors. So what the things will happen? As they are getting 10% per annum in the bank, they will demand again more income from the options trading. As they are doing the options trading, they will expect much more than the mutual fund, or you can say bank FD. So if the bank interest rate has changed from 6.5 to 10%, like say 3 or 4% it has increased, they will expect the more return in option selling. So naturally they will try to sell with higher premium. So option premium they will increase. Similarly, some of the people, the big investors or big option sellers, for diversification, no, they'll put some of their amount in the bank FD. Imagine that. Let's say for example, today I am putting 10% of my amount in bank FD and let's say 90% in option selling. Tomorrow, if bank increases the interest rate, instead of 10%, I may put 20% in bank FD and 80% in option selling. So that 10% volume has reduced in the market. If every option seller, he puts some of his amount from option selling to bank FD, then automatically volume is going to get decreased in option selling. Now if option buyers, they want to buy the options, the demand is there as it is, or demand has increased, but the selling has reduced. So demand is higher, or you can say supply is lower. So automatically rate will increase. So it's quite logical. Whenever the bank they increase the interest rate, the big sellers they will put some part, not entire part, some part in the banks. So selling volume is reduced. Buying volume is as it is, or you may say buying volume is as it is. Selling volume has reduced. So demand is more, supply is less. Rate will increase. Option premium will increase. On the other hand, similarly, let's say if the bank increases the interest rate, no, at the other side, the companies or the stocks, let's say Reliance, State Bank of India or Tata Motors, any companies, they have taken the loan from the bank. Okay, so as interest has increased, they need to pay more amount to the bank. So automatically what will happen? Share prices they will go down. Why share prices they will go down? Because their profitability will decrease. Let's say whatever loan a particular company, XYZ company, they have taken it from the bank. If the bank interest rate has increased, they need to pay more amount to the bank. As they need to pay more amount to the bank, their profitability has decreased. As their profitability has decreased, their share prices may be affected. Their share price may come down. So let's say I'm a retail investor. I'm holding few shares of a particular company, and let's say if now its share prices are going down, naturally I will try to buy more and more hedges. I will try to buy more and more insurance. So automatically in options market the demand will increase. So as demand will increase, the rate will increase. So all these things, they are connected with each other. Directly, whenever bank interest rate is increasing, the big option sellers, they'll put some of the amount in the bank. So the supply will decrease, demand is as it is. So the supply demand, it is impacted, so the rate will increase. On the other side, as the stock prices are going down due to less profitability, the people, they will try to buy the insurance, they will try to buy the put options. As demand has increased, again the option premium, it will increase. So it's a simple thing. Whenever bank it increases the interest rate, option premium they will increase. Whenever bank it reduces the interest rate, option premium they will decrease. But the change in interest rate, it does not happen so frequently. That's why in order to form our strategies, whether it is expiry day strategy or monthly strategy or quarterly strategy, generally we do not consider the row part. Row part I explain only for knowledge purpose, but that does not impact much for the option, what you can say, the strategies. The things or the option Greeks which they impact mostly for strategies no are delta, then gamma, then theta, and then vega. These are the four most important option Greeks which are used for the formation of option strategy. And all these things we have covered in great depth in our earlier session. So thank you for attending this session. Have a nice time and all the best. Thank you.